What kind of like stood out to say, hey, I just completely whiffed on that one.
You know, not only the move afterward, but the fact that we had 12,000 jobs last month, and this month we shot through the roof. So hey, we're streaming live on the other one too. So hang on.
We're live all the place. All right, so and we look at this non-farm employment change, 227,000 jobs added, forecast 218, previously probably revised 36,000. I mean, that seems like a big jump. I'm like, isn't it? You know, shouldn't we be? I mean, if we're talking about conspiracy, right? Would the Biden administration be more inclined to show true numbers if they are kind of falsifying things in the past, or would they be more inclined to make it look better?
That's
It's
that's where
a loaded
I'm
question.
it is a very loaded question because I mean it's certainly a political jab at the end. The question I think would be if the data what we're hearing is that they were trying to make it look better going into the elections.
Mm-hmm.
If they know that this is the last report before that you're already pushing into January, so the next report's in January. Does this make if you're going to speculate that they wanted to make it even look even greater, that it gives the Trump administration a bigger area to fall from.
Yeah.
I mean, we can speculate on that. It just the numbers just seem wildly absurd and way off track for what we were seeing going into that November report.
Yeah. I mean, we
I
overstated by close to 1 million jobs, and we
yeah
really haven't seen that work its way out. But Jim R asked a good question. He says, if you trust the number, if you don't trust the numbers, don't look at them. So here's the thing: there's two parts to this, right? There's whether or not you
mhm,
trust the numbers or not. But number two, you know that people look at the numbers. So you got to kind of look at it both ways. And in terms of saying, look, I may not fully understand the number or trust the number, but I do know that people look at the number and do look at it full heartedly. So I still have to regard it. And
yeah
so if we're publishing 227, what should the market's reaction be? I mean, isn't that the big question? If
well
we
yeah,
just
and
saw a
we
job go
should be
from
going up.
36 to 227, what should the market reactions be?
We saw the market reaction to it. The market reacted like it's supposed to. It shot higher. I mean, we volatility right around the first seconds, but then we shot higher, and we saw the S&P climb, we saw the Nasdaq climb, we saw this growth, and because the economy is doing well, and that's what you take that data to mean is that the economy is doing well. I looked at the JOLTS reports and compared that, and the JOLTS reports, job opening labor turnover survey, they said it didn't change much, but we're down 500,000 year over year. But they just said it didn't change much from last month.
Yeah.
And so they're saying the job available are not changing, but it's lower 500,000 than it was a year ago. And we showed that number dropped to 12,000, yet we're going to say it's jumped back up to 227. That still doesn't take care of the void of 200,000 jobs that were lost last month. Um, so there's more data to it than just taking the top level. So when you say you don't trust the numbers, I do trust the numbers if you can dig into it. If you can see what is going on behind the scenes, if you can say, okay, where are we really seeing the data? And like I said, I went back and looked at the job opening labor turnover survey, and they said we were missing 500,000 jobs from a year ago. And the number of total separations October was down 369,000. So they're looking at not just net jobs. They're saying how many people quit, how many people got fired, and the data doesn't hold up to that. We're going to see this. So is this all seasonal? Did we see early hiring? Because if we did, we also saw them get paid more. I mean, this is the data that we dig into. And average hourly earnings went was expected to be at 0.3 and it went up 0.4. So we're at a 0.4% average hourly earnings rate, which it's the same as it was last month, but higher than expectations. So if we were hiring seasonal jobs, I mean, what would you think, Brandon? Are we going to pay them more or less than what we normally pay the people we want to keep on for a longer time period?
You pay more, and we're seeing that job quitting, right, is
Yeah.
up a little bit.
Hmm.
Um, yeah, I mean, look, I mean, certainly could Helene be part of this? Sure. but we also overstated jobs by over 1 million or close to 1 million. So it's like we have this all this going on where the numbers have not been very accurate all year long. We haven't seen things work out. Yes, we could see a monthly decline. We saw 36,000. Could that be Helene? Now we're coming back off of it, or other calamities out there. Yeah, I guess it could factor in there. But again, we're just saying my thought is like, look, we just published 227. We're seeing average hourly earnings come in hotter than expected. And what I want to look at is what's good is bad, bad is good. Which scenario is playing out here, right? And what we're saying is that look, and we had a good jobs number, markets up slightly, but we're also seeing inflationary pressures on the jobs front. So I mean, is this really a positive result for the market? The initial reaction, surprisingly from my perspective, is yes. I thought the market would really want to see a more negative number and bounce off of that in anticipation the Fed's going to reverse and backtrack towards cuts, because right now they're moving towards not cutting as much
Right.
anyway.
Yeah, and we've got to remember we still have another one coming up here, and that's that pullback. We've already got it on the numbers. We've spiked up higher and we've drifted back. The Nasdaq almost has erased that entire spike, and I mean, I'm watching it live while we're talking about this. That we spiked all the way up and we're fading back down. I think people are reprocessing. Oh wait, that means I don't get that rate cut. That means I don't get the stimulus. That
Yeah.
means I have to reevaluate how good I think this really is if everybody's employed.
Yeah. And
So
in fact, even the bond market saw a little bit of a bid off of that number. I mean, it was kind of a rangy candle here, up, down, up, whatever. We're basically slightly higher, 0.21% from yesterday's close. So we're kind of moving slightly higher in bonds. Why? I mean, if the Fed is potentially, again, the wage pressures leading to more sticky inflation and the jobs market suddenly better, well, shouldn't this be negative for bonds right now? And again, right now, at least the initial reaction, no, but it's not exactly positive either.
yeah, and if it were negative for bonds, then that would be that combination of that. Well, I don't need the safety. I'm also looking at the rates to move, but negative bond prices, if we have less demand for them, that will prop those rates up and keep them from going down. So that will be that further indication that we are going to see higher borrowing costs. I was thinking about this, Brandon. I know I didn't bring this up, but it's going to tie into the things we're going to talk about in a second. And that is, I think the only way we see that the housing market fix itself is that long, slow, arduous process of having a wage increase over years potentially. I mean, that's that void. You're not going to see a market. I don't think you're going to see a real estate collapse like we saw in the 2008 crisis. And so it's good that we're seeing the average hourly rate climb. So your choices, I think, are that climbs up a little bit. Bond prices continue to climb slowly to bring the rates back down that people can afford, but it's not going to be the housing prices, I don't think. I was looking at that and looking at the data and thinking, we probably aren't going to see that happen, and we have to see the interest rates pull back so that we can see. And while we see employment prices or wages go up slowly
Mhm.
to make it affordable, it's wages have to catch up to inflation at some level, and
Yeah.
we might be waiting for a while.
I mean, historically, market prices and real estate have always been correlated to wages, which leads to savings, more investment. We broke that in the 90s with the Fed put. We became more interest rate focused. We're gonna have to revert more to savings. But again, look at what happened as EQ. This is the 30-day Fed funds rate.
Yep.
Fed funds futures here. We're seeing a big jump on the numbers. So we have better than expected, better than expected jobs numbers. Pretty good number if we take it at face value. We're seeing that wages are above expectations as well. Both things should maybe lead to a Fed rate increase rather than a cut. And yet we're seeing this go up. So if we take the
Yeah.
difference between 100 and 95 and a half, we're pushing towards lower rates, more cuts after the news this morning. And again, that's pretty unusual. So if we
Yeah.
go back to this
85%
question, what's good is
probability
bad,
based
bad
off
is
of it.
good. We're basically saying what's good is good. But the problem is, again, that does not, the Fed funds futures here is basically saying, no, the numbers are actually bad. They're not taking it at face value. And what we're saying is, look, the market's poised to, again, maybe rise a little bit, but it's on the back of this thought that December rate cut is more likely now, which is really odd given the numbers
Yeah.
we're seeing.
Yeah.
And
Everything would support not doing that. And 85% is what roughly
yeah,
I'm back of napkin
yeah,
calculating
it's
that.
hard when we're talking about a quarter point range
Yeah.
and factoring in here to calculate it, but Blake does pretty well with the back of the napkin stuff. So we go back to the ES. We're looking at the futures, the SPX, whatever. I mean, we've been on a pretty nice run here. We've had what 13 of 12 of 15 days, 13 of 15 days higher. Is a whatever the 12 of 14 days higher. But one of the things that's kind of interesting, I'll just bring up the SPX here, but the trading range on a day-to-day basis is just getting smaller and smaller and smaller. The average true range is close to 50 points. Yesterday it was 21. The day before that was 28, 18, 18 and a quarter. We're seeing just day after day, we're seeing just really, really small ranges in the market, and volatility diminishing, and the VIX is trading near lows right now. It's closed at a 13.0. We're at a 13.08 right now. We're back to the lows of May, June, July, or very close to it. And so when the market's high and the VIX is low, Blake, is that a positive sign for the market in the near term?
When the VIX is high,
VIX is low and the market's high.
it's time to fly.
Yeah.
I was trying to think of a rhyme that you could use when that's the case, but when the market's super high and the VIX is low, the idea is you keep letting that trend run, right? That's the bullish trend.
Right. You do, but at
But
what point do you start to take profits? I mean, this is where
yeah,
when we look at the VIX, yes, the VIX is low, but I like to look at 3-month volatility, which is at 16 and a half. The VIX is at 13.
yeah.
Well, if I look at a ratio of the two, and I'm looking at what are the expectations for future volatility. And we got to think about who's trading this market. We're talking about large institutions. And what's happening right now is that institutions are pricing in a rather significant rise in volatility in the near future. So we look over here, the 3-month VIX is 22.5% higher than the 30-day VIX. So right now we're looking at a very extreme expectation for a rise in volatility over the next month. And then we take another look at it. We take a look at something called skew. And this is just saying if skew is rising, it means the hedges are being put on. They're selling calls, buying puts. We just hit another record yesterday at almost 174. The downside risk right now is institutions are pricing them in through their extreme degree of hedging. They've never priced in more risk to the downside in the S&P 500 since the 1987 crash. This is the extreme. This is the highest point we've ever achieved in the skew index. And this is problematic, right?
Well, when you say it's the highest skew we've ever achieved, what does that extrapolate to? What does that, what's that mean?
It
When we
means
are
that
at the
institutions
record
have
difference,
never been more hedged than they are right now. And
never.
so
Let's
we
let's
just
let's put a put an accent on that. Never been more
never.
hedged.
Now, does it
Ever.
mean we crash? No. But it means that the downside risks have never been greater as far as being priced in the volatility markets. And on top of that, again, we have a scenario where the markets we're up here, right? We're elevated. The other side of skew is, yes, the crash risk has never been greater, but the squeeze, the upside is also very extreme. So you have these small moves up, 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 that eventually you realize the downside. So as we're seeing volatility get crushed, we're seeing the range on a day-to-day basis. This is also a consequence of skew, the squeeze higher in the market until eventually it breaks. Yesterday we saw a significant print, 1.3 million shares traded at 607.62 in the SPY. So I'm looking on that level right now today and saying, hey, do we finish above it or do we finish below it? The more we finish below that level, the more downside pressure may exist. So the other day I went through in my session, hey, how do you hedge the downside if you're an equity trader, right? If you have a lot of stock positions. number one, Blake and I have talked about being more defensive, dividends, but also at some point you got to have a plan to take profits. Stuff like MSTR, we've kind of highlighted this as kind of a poster child since back here, right? But we're seeing extreme volatility, huge gap and fade yesterday. Uh, uh, Bitcoin in general, BITO, for example, an engulfing, not engulfing, but a kind of a reversal, bearish belt hold, Mara, a lot of these high beta names we're starting to see yesterday volatility pick up, and you have a lot of weak hands here. So if you have a lot of high beta names, you might try to take some profits right now, pull something off, because again, you don't want to just give it all back because the market starts to slip here.
Well, and I'm going to throw one other idea that we didn't talk about pre-market, because
Uh-huh.
as you're saying it, it's clicking in my brain. And that is, with these high beta names, specifically with those in the crypto world, and people think that I'm just a perma bear on crypto. I'd say trade it. I don't believe you should buy and hold any of this, but trade it, trade in, trade out. But is this when everybody's doing it, right? Isn't that the indication that most markets are too hot? When we have some kid that, and this is not an exaggeration, some 13-year-old kid creates a coin, issues it, does a rug pull, and pulls $40,000 out of the market and is gone. And then, not to be crass, but the Haktua girl that everybody's talked about, $1.8 million on a rug pull yesterday
Yeah.
off of a meme coin.
Yeah.
You can't tell me that that isn't an indicator that these crypto areas are showing this weakness, that the weak hands are now in play. When you got a bunch of people falling for that, rushing in at all costs, damn the torpedoes, just full speed ahead, and running into crypto where they're losing millions of dollars in minutes because it's scams, then you can't tell me that this market, that specifically the crypto market, is a safe place to be putting money, or that it hasn't gone too hot, too fast, too far.
Yeah. Look, several years ago, 2020, I was like Bitcoin 100,000. Again, just the idea that we're pricing and what Bitcoin can purchase, even trading at a discount to gold could yield a 100,000 valuation on Bitcoin. We're here. But again,
Yeah.
we've gotten here very speedily in a very short amount of time. The question is, who's holding Bitcoin on the margin? Is it retail type investors, or is it institutions? And again, we'll find out whether we have weak hands in here because they sell a market. Now, Bluebird asked a good question about skew. Is skew elevated because of neutral strategies? Well, that's exactly what skew is. So if we're talking about neutralizing delta, what do we call neutralizing delta?
Hedging.
It's called a hedge, right? So that's precisely it, right? It's because they're neutralizing their delta, they're doing it as a hedge. And so we can very directly see they've never been more hedged. Now, since 2014, we've been in this upper range a lot and been there persistently. We've also had unprecedented monetary policy that's existed, and the unwind, people know it's going to be painful. So has there been a higher level of hedging? Yes, but I still consider anything over 130 high. We did see skew normalize for a short period of time after 2022. So we go back 10 years here. 2022, we saw it come down back into that normal range. So the point being is that right now we're hedged at a very extreme level because we know the downside risks are there. If we get a 20% plus decline, you expect skew to decline back down to the same area like in 2022. It's one of the reasons why I turned really bullish at the end of 22 for the upside. Okay. So this is not a very good timing type indicator. That's why I use 3-month to 1-month volatility. But we have to acknowledge that this is extreme, that people are neutralizing their delta at a rate that we've never seen before. Okay, so it's not changing, it's just the same thing, right? It's neutralizing delta, called a hedge. So we can say with absolute certainty, the degree of hedging that's going on right now has never been done before. And it makes sense. Look, COVID policies, driving monetary stimulus, markets way up. We hedge into that strength as the VIX is falling, as hedges become cheap. We get the selling, we get the bear market in 2022, for example. and the skew comes down. We pull those hedges. We want the upside. We went too fast, too quickly, so we've been hedged a lot, and now we're just seeing the hedge escalate even further. And this is not healthy for the market. So you have to understand is that the market may go down 5 or 10%, which I would look at this current environment and say that's the expectation. But if you look at the names that you're holding, you might be down 40% in that case, right? So you got to really consider what is your risk. So this doesn't say get short the market. This says you got to make some assessments. Okay. Do you want to hedge? What is your risk? That kind of thing.
Yeah, and as you talked about, this got to get a little too hot. I think I throw back to Icarus. A lot of people forget that Icarus didn't make his own wings. So when things get a little bit too hot, or how are you pronounce Daedalus or Daedalus' dad, his father is one that made the wings.
Mm-hmm.
And so it doesn't mean that we created this problem. It didn't mean that we as society, the traders, the investors made this problem. Is the government created this spending from the 2020 spending and the COVID stuff, and it created this situation that we're in. And so now it doesn't matter how close you flew to the sun at this point. That's what I'm concerned about.
Yeah.
We don't even need to be close to the sun. The wax wings will not hold. And that's what my biggest concern is on this. But it doesn't mean there's not bullish positions to take. It
Sure.
doesn't mean there's
Yeah.
not opportunities. That's why Brandon and I keep going back to say, look, we're not telling you to go,
Yeah.
scared running to the doors. Look for safety where you can make money while it's climbing. There's still stuff that will climb. There's stuff that won't fall. And like we were talking about just a minute ago, is that those dividend stocks, the dividend aristocrats, and those ones that are the safety defensive sectors, that's where you can still be, because even when that hedge, that skew comes down, that hedge is engaged for those big institutions. Generally speaking, those safety places are where we can still survive, if not profit, while the market's correcting lower.
And if you try to hedge your portfolio, how do you hedge a stock like Palantir? You
Yeah.
just can't. Right? Your hedge will not this could drop to 30 in a 5 to 10% correction in the S&P. You can't hedge Palantir. So you just have to what? You just got to sell into strength or sell into weakness. And what I will say, again, Blake and I have talked to thousands of people about their trading in the past. You get one big down day, nobody's going to sell there, right? You get another big down day, you might, but probably not. You're thinking if you're going to bet what you're going to see, you're going to give yourself, say, hey, if we can just get back to 60, I'm going to sell. And then you get back to 60 and you renegotiate. Well, if we get to 70, I'm going to sell. And then we start to turn over and like, well, why didn't I sell at 60? And then we break through the lows and all of a sudden you take a position that might have been short term and you turn it into a longer term trade. Because why? The common comment that people make is I've lost this much already. Why not just hold on? And then it
Sunk
goes
cost
to
fallacy.
20 and you finally get sick of it and you sell. Okay. So this is what we're talking about. There's stuff that you can hedge. There's stuff that is very, very difficult to hedge unless you do it directly. We're saying, look, try to take profits and stuff like this. Sell into strength rather than waiting for the weakness to materialize and then it puts you in that box in the corner, fight or flight, right? So that's kind of where we're kind of talking about, I guess. But but if we look at bulls and bears, we have stuff that is bullish. If the market keeps going up, what you can do, right? There's ways to find areas of strength. Right, Blake threw out his bulls this morning. XLEKO, those were two of mine that I had on here. IMO. Blake's talking some Christmas action with Hasbro.
Yeah, little Christmas action. Plus, it's a defensive stock. It's a big dividend payer, as a little
You're not
company is
going to
concerned.
disappoint your kids. What do you?
My youngest is 21 in this week, so
They don't
that's
like Transformers.
it probably does. I think on their wish list, so but they want the true lightsabers, the one they can actually
Yeah.
beat on each other with that glow in the dark.
Hey, the new Transformers movie was pretty good.
I've heard. So yeah, Hasbro is a good one for me. I think it's not just a holiday shopping action. It is a V-type reversal. It is a dividend payer. It is 4.17% dividend. You're getting bond level dividends on a stock that is created a price pattern, I would argue, that is set up for a V-type reversal. So you have both the dividend and the move here for an additional 10%. Hasbro looks great to me on this opportunity as a defensive slash holiday slash dividend play.
So would this be a long-term hold, or would you have a price target where you sell
I'd
into
have a
strength?
10% price target, sell up there at the
So
peaks, but see if I
up
can
here at
collect a
74.
dividend while I'm doing it.
Yeah. Yeah. So
At
look, I
least
mean,
one.
look, if it goes down retest 60, you're still
Mhm.
getting the 4%, right? And you have a chance to kind of weather the storm and just clip it up here around 74 as Icarus wings start to get melted. The
Yes.
wax starts to
The
wane.
wax.
Um,
Wax starts
XLE, I
to
think is
wane.
kind of interesting. I mean, if we're not going
Mixed
into
metaphor.
recession, I mean,
Hmm.
is XLE at a gap, at a low of the gap day right here?
Hmm.
We've pulled back. Oil still in backwardation, meaning that
Love
they're
oil at
pricing in a
68.
shortage.
Yeah, I think oil's solid at 68 too.
So again, this is not another opportunity to look at XLE. So again, if we hold 66, we rally. XLE's really outperformed oil generally. So again, if we can hold support here, we rally, target 98. That's a 6.5 point move. Sorry, 5.5 point move. It's not bad, right? You look at some of the top components, stuff like Chevron, for example. Exxon is another one. Again, Exxon at support down here. 125 pays a nice dividend as well at 3.5%. And we could see this get back to 125. I did this with Chevron CVX down here. All right. The idea is 165. We hit it. You get the dividend plus the potential appreciation. So in that case, a 10% move plus the dividend worked out pretty well for Chevron. All right. Altria, smoke them if you got them. This is kind of a near-term bounce. We already broke out. We formed this nice cup and handle formation. We got 49 to 55. That's 6 points. So still more to the upside here, up in that kind of 61-ish area. So we're getting a little bounce yesterday. Looking at Altria to continue, and of course, it does pay a 7% yield.
Well, and
But what?
one of the comments was owned Hasbro's for years. I have no problem letting this become the other one. I just want to be very careful at that peak. So just throwing that out there. Someone
Yeah,
commented that they've held it for years. I have no problem if you want to hold it for
yeah,
years
yeah,
for
yeah.
dividends. Yeah. But
What's your
there's a
basis, right?
lot of there's a lot of overhead on that one. That's the only reason why I'm saying I'd take profit on that.
So
Um,
Capital One, Blakes, we're kind of talking about the economy being is in a good position, is a bad position. We're looking at consumer loans, credit cards, other revolving plans. We're basically at all-time highs here.
yeah, we're basically at all-time highs. And the interesting, we had a little bit of downtick in defaults or um, delinquencies.
Delinquencies.
Just a tiny little bit of default, but I was looking at the data behind the data. I'd like to dig a little bit deeper into these things, and it's interesting to me that that little pullback that we saw may be because American Express is only at about a 1.5, 1.6% default rate or delinquency rate, but Capital One Financial's last quarter reported 4.4% delinquency, 4.4%, and that's including them shutting down hundreds of thousands of accounts where they can't spend any more money on them.
Yeah.
They know this is coming. They're trying to be proactive and get out ahead and cancel these credit cards or cap them out where they can't do it and cut the rates or cut the spending ability on other people that already have it, even if they're not into default or delinquency. And they don't have a hardship rule and like everybody else. So I think this is a really good opportunity to see this fill the gap and go all the way back down to 160. I think you're going to see that default rate accelerate. I think the data is going to bear that out. I don't think people can borrow on their credit cards anymore, and that means that they really don't have money to even make their minimum payment. So you'll
Yeah.
see a lot more delinquency kicking in.
About a year ago, there was about $1.5 trillion of available credit. So again, what Blake's talking about, that we're cutting that back here, right? So the available credit for many people,
Mhm.
someone mentioned the rejections might be up, but again, Capital One holds on to those balances, so they don't, they're not like Visa and Mastercard. They're for using Visa, for example, as a means to swipe, but they're holding on to balances like American Express, like Discover. Again, we got potential that we break 180 here. I mean, it's a pretty nice reversal pattern, but this
Mhm.
rangy spinning top on very extreme volume. This was a battle up here, right? This was a battle that went on and the sellers won. Buyers took it right back at it. They rebounded and we're seeing a little bit lighter volume selling here the last few days, but man, we took out the lows there. So that's a pretty significant area of resistance up there under 200. And again, we've got this support here. So we got this range. We start to break out of it. This could lead to a pretty significant correction of that prior trend.
Yeah.
Um, what was going on with Uber and Lyft yesterday?
I don't know. I just liked them from a technical breakout. I didn't even see the news on it, but both of them just got beat up. And so
Didn't they
look
might
at
have some
that.
sort of regulatory action? I don't know, man. But
I
this
don't
is
know.
big reversals in these products after again Lyft had very solid earnings, gapped up. Now we're just giving it all back. I mean, that's an example of people selling at market. That's a fast market yesterday in
Yeah.
these products. And again, it just shows who's holding them, right? So whatever came out, Google Waymo went into use in a state, so all of a sudden more competition. But again, we had to assume Waymo was going to make its move, right? So why all of a sudden now, right? So the idea is that there's definitely obviously weak hands in these products right now, and we're seeing the selling go on. So do you have a particular target? You're looking to close the gap here on Lyft, or
I want a little bit of a bounce and then fade that into all the way through the gap. So I'd say sell at 16, drop down to
yeah,
14 probably. And I don't like trading. I really don't like trading sub $15 stocks. Um, I don't think you can play it right. I don't think you can risk manage right. I don't think you can do the options the same way. So I
sometimes
prefer not to, but sometimes you got to take the trade.
sometimes if the vol's high enough, as the skew's favorable, this is 42 days out, but and not much there to get to 12 and a half.
Yeah.
But the vol's high enough, there's some premium to sell out here. Anything less, if you get less than 10 cents, that's pretty tough. You could construct the downside spread here, buy a 15, sell a 12 and a half. 12 and a half gets you back here. But like you said, you might test the midpoint of this candle, prior low. Both those are around 16 and a quarter, or
Yep.
even maybe move up to 16, you get in ahead of it.
And
Um,
I'd say you could do the 16, 14 and buy in the money because that skew is lower even there.
Go
So
in the money, yeah.
yeah.
So you could push it up, increase the cost a little bit, but 14, you're still getting, 40, 42, 43 cents for that. That really eats into the cost there. Higher volatility makes it a cheap spread. And look, you get to 14, maybe a little bit through it, you're done. You make
Hmm.
70 to 100% return on it. That's not bad.
Yeah, not a bad
Uh,
little.
I'm going to throw a bite to a little bit, but just the idea that, hey, this is a risky level, just like Capital One here. We gapped, we faded yesterday. We saw higher above average volume. We start to take out the low at 24.15. These could significantly reverse. And we saw Mara, do an intraday reversal yesterday as well. Be careful here. There's a lot of weak hands that they'll start selling at market. Their stops start to trigger, boom, boom, boom. You start
Hmm.
to see a fast market like an Uber and like a Lyft creates problems. And I'll throw out XHB, but man, like just here, my neighborhood, I'm like, they sold all these homes, they've built them, and all of a sudden it's just hit a brick wall. I'm like, nobody's buying the properties. And I talked to a friend of mine, it's a developer, the south and further south in the county. They're not getting any showings. They thought the Trump getting elected to get the bounce back. It's not happening, folks. And we
Yeah.
kind of closed the gap,
I
looking at
have a friend
retesting
that
the lows
has
at 113.
not sold a single home, a realtor, in 12 months.
Yeah. It might be
It's
part of
hard
his
to.
problem too. I don't know, but no, but that's it. And again, it is hitting a wall right now.
Yeah. Yeah, it is. And that's what people ask me like last week or the week before, am I still bearish home builders, even though it's shooting higher? I said, I can't be bullish here. I've
Yeah.
commented on that before. I cannot be a buyer here. I'm still bearish. I don't think this is sustainable.
Yeah.
And so the bounce is reversed back. We didn't clear the high. It tried, desperately tried, but it didn't do it.
Yeah.
So,
And look, I mean, you can look at some of these components like Lennar, for example, LEN,
mhm,
and say, oh, look, they're a value stock, but the reality is there's a reason why they're a value stock. These are highly cyclical businesses. And so
yeah,
again, whether we actually go into like a 2007 scenario, 2006 scenario, it doesn't matter. I'm like, all they have to do is just, if they're not able to make money on selling homes, they're not selling homes. The price is going to go down, even if real estate prices don't drop appreciably.
yep. And I don't think you're going to see prices drop. I can't say the word today. You're not going to see prices drop. I
Yeah.
think you're going to see them fade a little bit, and it's going to be a long slog of people slowly buying out of desperation, and people, home builders, not willing to take a loss and taking bigger losses. So I think you're going to see it on the back of the home builders before you see any just normal market driven lower prices. So
Tony says they're moving to Florida. I might say they were moving to Florida.
yeah,
You like post hurricanes, man. Also, you saw that just the uptick in people selling their homes. But yeah, I don't know. Like it's again, people might be moving, shifting states, and they might be more willing to buy in one state and more willing to sell in other states. So prices. But man, I'm looking at real estate price in Utah compared to the past. We're well above Vegas right now. I'm like, we're a little bit below Arizona. I mean, prices are absolutely nuts.
yep,
So
yep.
anyway. People don't want
Well,
to give
we're
their low interest rates. That's definitely a reality. Yep.
yeah, no one wants to sell their low interest rates, so it's not you're not going to see other homes sell, and the home builders are going to hang on because they don't want to take a loss.
Nope.
If they only have 10 to 15% margins in there, they're not going to sell it for 10, 15% less unless they can't meet their debt obligations. So
Right.
they're just going to sit
And
here.
the indication is prices just got to come down for them to be able to get the showings and
Yep.
account for the interest rates. And so, yeah, we'll see. So
All
again,
right.
moral of the story right now is that what have we kind of talked about here? The idea that look, we have a situation where look, we got to start to price in the downside risks, looking for stuff that's more defensive oriented is not a bad deal. And we're kind of in a situation we gotta figure this out again. And I think the kind of the mixed up reaction to the jobs report today was kind of telling of that.
Yeah, and the dollar and what I was watching on the side is the dollar just continued to gain all morning long. And so we're not pricing in rate cuts. And yet the CME and the Fed Watch tool and the bonds are pricing in rates staying cut, but dollar is getting stronger and stronger this morning off
Mhm.
despite that. And it's a mixed story here. So we've got a really interesting little quandary. So it's a tough
Uh,
read.
we got to pass it to Don, but it's been a pleasure being with you folks this
Thanks.
morning.
Thanks, everybody. And thank you, Brandon.
Thank you,
We'll
buddy.
catch you. Both of us will catch you later on today in the main room.
All right, have a great one.